Hi everyone, welcome to Fin Modeling Orb YouTube channel. Today we are going to be talking about real estate investment analysis. So we are going to be building a very quick model that you can use to assess investment opportunities in real estate very quickly. I mean, this is something short and quick that you could use as a first step of analysis. Then you could probably build a more robust model. That said, without further ado, let's jump into what the modeling is going to look like. And I hope you guys enjoy the ride with me. So I'm going to be using assumptions that are right out of my head, right? So that's what we're going to be using. So yeah, let's start. So firstly, I like to format my model properly. So I go on modify, click on format, then I go to numbers. I like to use numbers, comma separator, just to change my font. Sorry, font. I like Cobel. I could use Arial actually. And Arial size 10, regular. Okay. I'm gonna name this input style. Fill. Border. Select the border. I'm gonna be choosing a color that makes it distinct to call out. Computer is lagging. So excuse me. We could use this is okay, right? So you can set up as many styles you want to use, but because this is not a very robust model, this is a quick model. I'm very fine with just setting up my normal and my input. Along the line, I might figure out something else that I need to set up or want to set up. So I am going to do this. Just so you know, I can set up a field to also do what I'm doing manually, but we're going to be having another session that's going to be talking about best practices in formatting your financial model. So I'm going to name this real estate white. Just want to bold in this. I like to do this for my models. I mean, this is not compulsory anyway. So then just to note, this is going to be a yearly model. So I have start period. I might as well have just, you know what, guys, just a moment. So I haven't done these. So general assumptions. So model start date, usually the first thing I like to do. And I usually like to name model start dates because I'm going to be using it a lot. So let's say 1st of January 2024. To change the date format, Control 1 is something you could do. Come to number, come to custom. You could select any date format you want, but like this. Then I say, I haven't done this. This equals to model start. Big mistake, right? So I named the wrong cell. So what I need to do is just come to formulas. Then I go to my name manager. Then in my name manager, what I need to do then is to, so in my name manager, I need to just delete the name. Yeah. Then I click on close. Then come back to name the right cell as model start. Okay, good. Equals model start. Perfect. Then I just want to also control one. Again, for the benefit of people who didn't get this earlier. And I choose this, which is the style I like to have. End of period, I could use EOM. It's an end of month formula 11, I think, or 12. Sure. But we'll check. Perfect. So this plus one. And I drag this. Shall we make this a 7-year model? Let's move this a bit more to HFP. Let's move this to the right. And let's make this 7. It's an input style, just so you guys figure that out. Auto HFP. Yeah, this changes the number of things. There we go. Then equals model and it. We can then formularize this to say you could use months or what say months. So let's do this. Days in a year. We've got 365 months in a year. Got 12 weeks in a year. We've got 52 days in a week. Seven days in a month. Technically, we've got 30 on an average. So I haven't done this. What I can then do is to say model period in years. I could do the same. Model period in months. And I can go ahead to do cost 7 times 12. Just to make this stand out and unique, I may like to change the font of my unit. I call this my units column. So that's fine. Days, months. Did I just see something pop out now? That looks nice. I've never seen that before, but check it out later. So I could do EOM. So this is one way of doing this actually. There are other ways you could do it. I could have applied that formula straight up to I could have applied that formula straight up to something is right here. Just 1 second. Sorry, EOM model start. Okay, F17. Yeah, so I could have applied a formula directly to the year, but I like to break it down like this for simplicity purposes. And if I were going to be building my model on a monthly basis, I want to see the number of months the model covered. So sometimes I like to do it like this. Again, I mispositioned this, so let's just shift it. Yeah, shift it. Nice. So you can like to call these input units. Some input, input style. Good. So essentially, wherever you see the yellow bar, it means that yellow bar is being fed into another part of the model. So we can call these model date assumption. Nice. So to my mind, we have the basics of the model. Just a moment, formatting just to look nice. Yeah, so looks good. Let's expand this a bit. Then let's contract this a bit. Sure, I'm going to be needing the column G. That's why I had to do this. So for the general model assumption, for the model, we can call this model assumptions. So firstly, I'm going to start with the use of font, and I'm going to explain. So what I'm trying to do here is let's assume I've gotten the property, right? And I know how much the property is worth. So I want to begin to lay out what my use of font is going to look like. So firstly, what comes to my mind is the acquisition cost. For this, we assume Great British pounds as the currency. So let's assume it's a 450k property. As an example. So let us, of course, when you buy a property, you expect some unforeseen expenses. Let's just assume there's an unforeseen expense. So we'd say call it miscellaneous, and let's assume that about 2% of the acquisition cost. 2%. Auto J impute at HP GPP. That's Now I've decided to separate the percent and the pounds value just so the model is easy to update and for flexibility purposes. As an example, if I change this to one, it changes, I change this to two, it changes, right? So that's how you build flexibility into your finisher model. Great. So we can then come on to say other form of fees, legal, stamp duties, whatever it is. So we say legal fee, legal management, brokers or something, broker, and any other fee. Again, percentage of cost of the property. In some cases, it could be a flat fee. I mean, that's for you to update, not me. So I've got 3%. It only gets better. I do this. 1 second, guys. I like to freeze this because I feel like it's going to be very useful as we move on. Again, remind me where the freeze is here. Perfect. This is what I actually want to freeze, which is fine. Okay. Control D, GPP, do this. Excel does this thing sometimes and it's quite annoying. Just in case you've been wondering what I was using to copy and format paintings, Alt HFP, and drag it to the point you want to format. So we've got this. Then what other thing can you think of? Probably tax or something. You can always put that in the model, just the same way I have done to come up with your own use of fund. But let's just keep it simple. So what I'm going to have here is Alt HPP, say total cost of acquisition. Of course, it's GBP 13.5, which is my broker fee plus miscellaneous. Which can capture anything at all, and the acquisition cost. So my total cost of acquisition is going to be £472,500. So let's take it a bit further. So let's assume you don't have the whole of 472,005. There are cases where mostly what people do is to bring up their own equity portion of the property. Then the remainder portion is financed through mortgage from the bank. There are instances of shared ownership where two, three people can essentially, put money together to acquire the property. But for simplicity's sake, again, we said it's a very quick model. So let's assume it's a co-ownership kind of thing. If we're to do mortgage, that's going to be a separate class because we're going to be modeling debts, repayment, sinking fund, and what have you. But let's just go ahead with the assumption that two people are coming together to buy this property. So we say owner A stake. So let's say equity stake in a property. Owner A has 50%. Owner B and I like to automate this. So say 1 minus 50%. Let's assume owner A owns the model. Perfect. Now I decided to make this 1 minus 50 instead of having to add code just because of flexibility purposes. So as an example, if owner A reduces his stake to 30, automatically B owns 70. Very basic assumption, right? Good. Almost there. Almost there. So on this part of the screen, I want to build what I'll call my returns assumption. Basic one, promise you. Just some finessing. Yep. HBO. Great. Of course, when you buy a property, you're going to be renting it out, right? So monthly rent, let's assume that's going to be GPB, as you can imagine. I've got GPP, so let's assume a monthly rent of £3,000. All right, yearly rent, contra D. All right, guys. So this is where it's important for you to always set out a general assumption. It makes your life easier. As an example, I just do 3,000 multiplied by 12, and I get my yearly rent. This is a calculation, but could also be input. So you can like to shade it yellow or not. The choice is really yours, guys. The choice is really yours. So let's leave it out to just make it look nice. Of course, over a period of 7 years, the model is supposed to end December 31, 30. I think we missed that out. No worries. We're going to do a lot of finessing at the end of the model. Troubles. Of course, the rent is not going to be stagnant. Rent is going to increase. So we can see rent escalation, rent escalation, percent. Essentially, rent is going to increase by 10%. Then we can say, because we're building a model for owner A, who is the owner of the model, so we are going to tailor the assumption to fit A's investment. What do I mean? So, share of rent, assuming rent was going to be shared equally, again, based on the equity contribution, of course, which is the reality of the day. So, £18,000 per year is what is going to be coming to Mr. A. Now let's take this a bit further. So let's assume the investment horizon for Mr. A and Mr. B is 7 years, and while entering into the joint venture, which is the case here, they both agreed to sell the property after a period of time, let's say 5 years. So that's something we need to capture into our model. So we say sale year, sale year. I'll do 7. Of course, it's going to be very flexible. Then I need to also calculate how much is going to be coming to the owner of the model. So recall acquisition cost is link up to this place. I could build something for linked sales, but that's by the way. We'll talk about that later on. Sales sales margin. So my thinking around here is to say, look, guys, if we're going to sell this property, we have to sell it at a point where let's assume we must have gotten 20%, or at a point where the offer to buy from us is at least 20%. So you say sale margin 20%. That means the selling pro revenue from sale, GPP. It's going to be marked up by 20%, 1 plus 20%. That means the property will need to be sold for 567,000 pounds, right? Okay, let's move on, guys. Revenue to owner A based on their equity holdings is going to be, so at the time the property is going to be sold, owner A is expected to receive £283,000 cash from the sale of the property. All right, guys. So just to make this a bit cleaner, again, this is just for optics. It's not entirely necessary. You don't have to do this. Allow me to bring this. Allow me to bring this down a bit. Yeah, just to. I mean, it's optics anyway, so. And I can actually say this is. No, you know what? I'm going to rename this as my source of fund. You could see. Perfect. Just gonna adjust this a bit. And again, just never mind the dates. Let's just do a bit of adjustment to the columns. Optics, right? You can do whatever you choose to do as long as you have a functional model, guys. That's the most important thing. Okay, so for me and for the purpose of this class, we have our assumptions nicely set up. Okay, so just to complete this equals year 2024. Okay. So the first thing first will be for us to build out our flags. Again, recall that we are going to have a rent escalation. So let's do this as workings. Then we start off with our rent escalation flag. Then I'm going to name this my increment impact. Then I'm going to name that increment starts year. This is something I should actually have in my inputs. Take this down a bit. The thinking behind this is the fact that you can't just increase rent the year you buy the property or the next. It takes a while. I mean, given the rental laws in certain countries, for example, the country that I'm from, takes you increase the rent 2 years, every 2 years, I believe. So my rent increment start year is going to be from year three in this case. Then, yep, so it's time to build out my flag, and I'm going to be using a formula to do that. So I'm going to write the formula. So to write the formula, we're going to be using a combination of if function and offset function. So just carry along with me, guys, step by step. So the first thing is you write if. So what we're trying to do is to say we want our rent to start increasing from year three. Anything below year three, we do not want our rent to increase. And the first thing you can do is to say if year count equals year three, which is the year we want our rent to start increasing, we say give me one. Otherwise, if year count is less than year three, recall we do not want rent to increase anything below year three, but we want it to increase at year three and every 2 years and above. So we'd say if yeah, give me zero, otherwise offset offset where I am, column zero, still where I am, and jump by 2 years. I'm going to explain it too. Just a moment. It should work. So again, one nice thing to add: escalation by year. Is this the right way to name it? No, that's not the right way. So we can say rent escalation frequency. Yeah, two. Now, so what I need to do is just come onto displays and reference this. So let's try that out if it works. Yeah, it does work. So as you can see, from year three onwards, rent increases every year, right? But if I make this from year yeah, if I make this two, from year three onwards, rent increases every second year. 2026 increase, not increase, increases, and what have you. All that makes sense, guys. So yep. So the next would then be to write out my rent increment impact. But before then, we can make this an input cell. So how do we calculate our rental income? So recall, guys, that at some point we are going to be selling the property. So we only collect rent when we haven't sold the property. So what that means is we need to write a formula to capture that. So we do if the year is less than or equal to the sale year, kindly collect my rent, which is this times my share of rent. Otherwise, give me zero. So let's see how this works out. Cool. We got our £18,000. Cool. Perfect. So, guys, something very interesting here. I've decided to make this work as it is currently working, but I also reckon that At some point, it's possible you sell the property in June, and in which case you are not going to be able to earn the whole of the £23,000. So what you can do is to fix something. So let's say, for example, one, one, and I'm sure I'm going to be selling this property in June. That's going to be 0.5. Then what I just need to do is to do this, then multiply the whole function by 0.5, in which case I receive lesser than what I currently get. Right. So these are other forms of tweaking that you can add to your whole model based on how certain you want to go about the whole disposal of the asset or acquisition of the asset. But this is just something to get on a start with. And I can take this out. Great. So the next thing is for us to consider a situation where you probably sell the property in December, for example, December of 2030, okay, which is year seven. So again, that requires us to write another form of formula that captures that. So that's a simpler formula to write. So what you just need to do is to say if sale year freeze equals this. Simply give me my own share of revenue from sale. It's as simple as that. Otherwise, give me zero. And that's it. So this is all that comes to you. So total revenue. That's all that comes to you. But again, recall we assume the management fee. So I'm gonna do management fee. That's what you typically pay to your agency to help you collect your rent. And I do. Same guys are gonna help you sell your property in most cases anyway. Yeah, so it could be more than 1%. I mean, this is just me trying to be as luxurious with numbers as possible. Should we assume tax? Okay, so let's assume there's a capital tax. So capital gain tax here is going to be administered on the profits. So, oh no, that's a mistake. Similar formula, just copy. Then I'm going to paste this. But this time around, it's going to be I'm going to calculate my capital gain tax as sales minus my own share of the acquisition. Okay. All right. So that's something that we also missed out in our assumption. So let's quickly work that out. Double checking as it should be. Okay, guys. Okay. All looks good. So back to the formula we're about to write. It was the same thing, a similar formula as the sales. What's a bit different here is the fact that we are not selling the property, rather we are in this case accounting for tax. So what we are going to do is to say on the date of sales, we want the sale price. Come on, Excel, come on. My Excel was misbehaving. We want the sale price minus our share, which is the cost price, to be taxed. We need to freeze this up. And we're taxing that by 5%. And this should do the magic for us. It's done the magic. Perfect. So do times 5%. Something is off. Always nice to double check. Oh, okay, got you. That's because this is fully on the sales tax. Meanwhile, the capital gain tax is on the capital gain, which is the selling price minus the cost price. That makes sense. So we say we can call this net cash flow, and we should be wrapping up the model. Come on. Yeah, that's the net cash flow. So just to do a couple of analysis. So these are the series of cash flow you're going to get as an investor if you invested in this property. So just to check if this is working as designed, let's make this 5. Exactly. So it works as designed. Let's make this 2. Perfect. So we take this back to 7. And we've got our net cash flow. So let's just do some return analysis to see cash on cash multiple, cash multiple. To do that, we need to have in negative terms the amount that was invested in this deal, which is 236K. I can shade that just to signify there's something worthy of checking there. All right. So once we do that, we can simply just do equals sum of my series, or let's stay there, equals sum of my series of my cash flow divided by negative of this guy. Then I can do this to say I want to do custom. So which means I get 1.7 times the amount that I invested in the back. Then we can do the IRR, which is also equals IRR. What's HP? 10%. Well, yeah, I like to use IRR here because this is more or less like a series of equal cash flow. But some people will argue XIRR is something they also use. Again, I think XIRR is more reflective when they are series of um, non-consistent cash flows. So just to, if I wanted this to work, I could do this minus one, so equals XIRR. I mean, rental income is, it's a constant and equal series of cash flow. So I'm not a big fan of XIRR for that. Should be in the same range anyway, 10%. So yeah, so it's the same range because the cash flow is consistent over a period of time. So if you were using something that was inconsistent, perhaps you get money today, you don't get next month, you know, stuff like that. XIR becomes more suitable for those. So guys, this is how you can build a very quick model on that one art to assess the viability of a real estate investment. Other things you can do to this model include sensitizing the model. Okay, we'll do an example of sensitizing the model. But just in case you are not very familiar with sensitivity analysis, you can go back to our previous videos to see we talked about sensitivity analysis. So let's just sensitize rent escalation in this case. So Alt HBS, Alt HMC, rent escalation. So we start off with the middle ground. So 10%, Alt HP minus 3%. That doesn't look like the middle ground anyway. I like to highlight the side. And on this side of things, we can have this sales margin as an example. So in this case, my sales margin was 20%, 20% of HP, 5%. What are we sensitizing? Let's sensitize our cash on cash multiples. Forgive me, guys, I need to expand this a bit. Makes my work easier. All right. All right. So once you, oh no, what did I just do? This is not right. Let's take this up. Let's take this up. Perfect. So once you have these guys, you can just go to data, what if analysis, data table. Then you set your row and your column input, right? So in this case, our row input is the sales margin. So you come to your sales margin, and our column input is the rent escalation. So you go look for your rent escalation, and that is, yeah, no, come on, Excel. Yeah. And let's see. Okay, just a bit of formatting. No, 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 wait, no, wait, no, wait, no, wait, no, wait. Uh, so let's do a format painter again. Yeah, guys. So we are currently at 10:20. I want to fix this there. In 10, are we at 10:20? Yeah, we are at 10:20 actually. So we have 1.76 instead of 1.78. That is strange. Let's look that up. 10, 10, 10. Yeah, yeah, yeah. So sometimes this happens when you probably flip the, or you probably flip the whole thing, right? So just let me check this a moment. So let's try this again. I probably did not pick the right thing. So we do this. Okay, pick. Oh, I see what the problem was here. Excel, and let's see. No, that's not what I wanted to pick. Yep, so this is correct now. So as you can see at 10-20%, we have 1.78 return. If we increase our rent escalation from 10% to 13% while keeping the sales margin as 20, we get a better return. And at 7% with a 35% margin, we get more. So this is the sweetest spot, guys. This is the sweetest spot. Label it green. You could use conditional formatting. We showed that in our earlier video, right? So, and the point is, of course, where you sell higher in terms of the sales margin and increase your rent by the highest. And this is probably going to be the weakest spot, I believe. Yep, and that's the poorest combination of rent escalation and sales margin. So, guys, this is us building an analysis for a real estate investment under just an hour. It could be faster than this if I was doing this by my own, but because I had to show you guys on a step by step basis, it took a bit longer. So this could be like a first level of analysis that you could do before then building a deeper, wider, broader model considering all other factors. Thank you very much for staying with us, guys. Remember to share, remember to follow us, remember to comment. In the comment section, you can just put a note if you want me to send rather the Excel sheet to you. I'm happy to do that. Just put a note in the comment section and ensure you're following us. Thanks a lot, guys. Have a very nice day ahead of you. If you're in the night, have a very nice sleep. If the day is just starting, I wish you the very best ahead of the day. Cheers, guys. Bye.